What if everything you think you know about scaling organizations and companies is wrong? I am Priyanka, and today I'm sitting down with Wharton's Professor Gad, who's the creator of revolutionary scale framework. From AI scaling secrets to building unbreakable competitive moats, this conversation will transform how you think about growth.
What people like to say, what brought us here will not take us there. I say what brought us here will be the main constraint from taking us there. We many times need to unlearn some lessons and keep others. What burning issue you're solving? And so what is how are you making sure you're selling a painkiller, not a vitamin? Culture feeds your strategy, but the wrong strategy will now change the culture because the people who stay will be people that believe in the new strategy that you have.
Thank you, Gad, for joining me today. And let's just get started with a little bit of an introduction to let people know who you are.
Yes, my name is Gad. I'm a faculty at the Wharton School. I'm the director of the Management Technology program between Wharton and Penn. But throughout the years, while always in academia, was a founder, worked in tech, was a software developer for many years, worked with tech firms, invest in tech firms in different configurations. And primarily teaches a class on scaling. This is the topic that I like to spend quite a bit of time on: how firms scale, how do they build moats, should they do that, how fast should they do, and that has been really one of my main topics of interest for the last few years.
Awesome. And scaling class is exactly how I got introduced to you at Wharton. And I am so excited to dive a little bit more in. I learned so much about the scale framework that you coined and created. And we will dive a little bit into the scale framework because currently with all the AI companies, all the conversations that I'm having are around how do we scale the products that we're building, right? So I'd love to dive deep into that. With that, as we get started, maybe we start off with the scale framework, what it is, how did you come up with it from the inception?
Yeah. So the idea of, first of all, the name, the scale framework is a mnemonic device. It's just more for people to remember that. But it really asks 5 questions, and the questions are really trying to do a very simple thing, which is one of the main realizations that I had from both being a founder, but then working with many firms in different stages, really from pre-seed, many times before even multiple founders meet, all the way to IPO, is that the way I describe it in my class, I say, what people like to say, what brought us here will not take us there. I say, what brought us here will be the main constraint from taking us there. We many times need to unlearn some lessons and keep others. And so with the scale framework is really built on both research and a lot of experience and being continuously iterated and ask 5 simple questions. The first question, and I'm not claiming this is the right order to ask them, but these are sort of the way that they construct the scale a framework. The first one is this question of, is the firm scalable? And when I say, is it scalable, the question here is, can you really use growth as a way of deepen your moat, as to deepen your durable competitive advantage? And so we try to look at data, try to anticipate how the model is going to be built, how the product, and then we can talk more about that. So the next question is, the constraints. One of my main philosophies in thinking about working with firms is that in any point in time, you have to identify what is the main constraint. And the constraint can be on the supply side, can be on the demand side, can be product, can be a processes that you have too many processes, not enough processes, and the like. The next question is the alignment. And alignment is really the question of, to what extent the different components of the business model are actually working together. And so here comes the main issue, which is most firms start with the notion of product market fit. And product market fit is really this idea we have product that is solving a real problem in the market, the value hypothesis, so to speak. But as firms grow, many times they continue to do the same thing with the belief that the next cohort of customers is exactly the same as the previous one, and that's usually not the case. Every new cohort brings new issues, and every time we get the system a little bit out of sync, and we need to make sure that we bring it back to sync. Otherwise, very high cost of acquisition, because we promise things that are better than what we have, and we need to then pay people to try to come, or we have very high cost of attrition, because again, we overpromise and under-deliver. L stands for leadership. I usually say that I joke a little bit that it really the L was that I needed L for the scale, and it's really not about leadership per se, but it's more about the question of human limitation, the question of do we have the right people, the right culture, the right processes, and the right structure to deliver where we are. And here, again, the idea here is that as firms grow, they bring new people, these new people bring different belief systems. How do we make sure the culture doesn't get out of sync, but at the same time, how do we make sure, for example, the culture remains cohesive? And then finally, E stands for efficiency. Efficiency, at least the way I think about it, is not so much operational efficiency, is the question of, is there a predictable path to profitability? So if I'll take these 5 together, they're basically asking a simple question, which is the firm ready to make the next leap, the next step?
Yeah.
And it just attacks it from multiple angles. There is a strategy angle, which is the alignment. There is the financial angle, which is efficiency. There is the human aspect, the structure, which is the leadership. And each one of them is trying to bring a slightly different angle. And what we are trying to assess is some set of priorities. What are the things we need to do now that unless we do them, we should really not grow? What are the things that we can delay that will let maybe fires burn? And also how much urgency there is to grow. To what extent, you see now, if we talk about tech, and I'm sure many of your listeners are from tech. I mean, it's interesting to see the amount of the rounds people are raising these days. And so it's very clear there is a lot of urgency to grow. But why? And so some firms, you see that, right? So I can actually see why OpenAI is raising these bigger and bigger rounds, and I can see why Anthropic is raising these bigger. But why is Cursor raising these rounds? Not less clear to me. And so happy to get into the discussion, but that's a little bit the question.
Actually, let's, I'm just for the pickup, I'm going to say the question again. You don't have to answer it, and I'm going to dive into the follow-on from there. Can you define what the scale framework is, and which of these things comes first? What does the founders and the leaders do and operators can do to practice that in current environment? And then I'll just stitch that question back up front. Okay. My follow-up question is, why do companies continue to bring on more capital, raise more rounds, when we know that scaling is a different beast altogether? I'm just curious to get your thoughts on, you mentioned Cursor, some of the other companies doing the same thing. What are your thoughts, and what do you think about, like, I'm asking this question because I also took the VC class, right? In the venture capital class, we learned that the more rounds you raise, you obviously are diluting your own stake in the company. So that's another lesson. But then you're also on the path to, as a founder, to be doing the things that help you grow and expand as the VC's exit is going to depend on that. So I want to bring all of those things together and get your perspective on scale.
Yeah. So I think, to me at least, I go back to the main question about growth, which is, can you use growth to generate a deeper and deeper competitive advantage, and a more durable competitive advantage? And there are situations where that's the case. So I'll give an example, just simple example. Facebook, when they grew, they knew that the only way they're going to create more value is through their network effects. Network effects basically mean that the more customers you have, the higher the value for these customers, but also for advertisers, which is the way they monetize. So in one point, you absolutely have to go and spend more money, build more servers, get more people to write code to make sure that the information is stored, that the data is stored, that the pictures are stored. One thing they learned from Friendster at the time was that if there is even short latency, a slight latency, there's immediately drop off. So all the money went into building more and more infrastructure to allow for these network effects to materialize. Same idea for Uber. Uber, for many, many, many years, was unprofitable. And so people questions really why pour so much money into something that there is no line of sight into profitability. But the reality is that people that looked at that said, it might not ever be that widely profitable, but because it builds so much on network effects, you do need to have enough drivers. You need to have enough customers. The more customers you have, the more drivers you have, and vice versa. And sure, there will be other competitors continuously, from DoorDash to Amazon to Lyft, but ultimately, once they are going to cross a certain threshold, that's going to translate into very low profitability, but very a strong cash flow. And that's indeed where Uber is now, many, 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 many years after that. And I think some of these firms created that notion. But notice, both of these firms are built on very strong network effects. The other ways firms build moats. I mean, you can see Tesla at this point, both their charging stations, network of charging station, which is the reason to buy that. One other one is, of course, their cost of cars that are declining very, very fast. Maybe not as fast as they would like it to grow. But it means that at this point, if you want an electric car that actually you don't really have to continuously think about where's the next charging station, I mean, Tesla is the option. And of course, it was wildly unprofitable for many years. Yeah. Now, what's my main issue with firms like Cursor and many of the other firms that are emerging now? The main issue is that I don't see, like, Cursor is a good example, and I'm sure the audience heard about the firm, and if not, I'm sure they can actually read. They came on the heels of GitHub, in fact, even if you want, and Copilot on GitHub. And they themselves admitted that they essentially, basically, they used the fact that Microsoft was not fast enough to further develop Copilot and wasn't nimble enough, and they basically took the idea, just better executed it. But they also themselves admit that by the speed by which things are moving these days, it's actually very, very possible that a year from now, many of their customers will actually switch to another firm who might be better off. So here comes maybe another reason that firms sometimes stay with a customer, another way to build a moat, which is, I think, what I like to think about SAP, for example, SAP or Oracle for many years, which is what we like to call switching curves or customer stickiness. That's another reason to grow very fast, because if you can actually ensure that your customers are going to stay with you because they're going to invest so massively in the relationship, and in which case raising these big rounds, investing in customer acquisition, losing money on every customer is going to pan out well, because the lifetime of a customer is going to be very long. But we see Claude Code and we see OpenAI working with around that. And so in any point in time, I unless you can reduce the cost, so the way I want to think about the following, unless you, with every additional customer, reduce the cost for the next customer, or with every additional customer, actually really provide better value for the next customer, or with every additional customer, lock in the next customer, it's going to be very, very hard to translate that growth into a better moat and a deeper moat. And many of the firms I see now, I see it primarily as the following reason, which is, I think there's just too much money. I mean, chasing too few deals. It was funny. I met Andy Ratcliffe a few months ago. Legendary, the founder of Benchmark, Wharton alum, and the founder of Wealthfront. And he said that his sense is that there are too much money chasing too few deals. But you remember that Don Valentin gave a talk at Stanford in the 1980s and said exactly the same thing. And he said that's the constant in all of these industries, right? Like, so it's clear there'll be a few winners. Everybody chases their founders to give them the money to run. Some of them are going to emerge victorious. They might not have the share they want to have, but they're going to be massive firms. And investors have really no other option, because if they stay and wait, there is basically, they know they're going to lose. So at the very least, they're going to try some of these deals. But that's what we see. If you're now, when people ask, is that a bubble? By definition, it's going to be a bubble, but the bubble doesn't mean that there are no firms that emerge with great solution out of these bubbles. You just don't know who.
Yeah, just don't know who, and there's too many options in the market. This is, I guess what you're saying is, if you don't have a strong competitive advantage, or a durable, not just strong, durable competitive advantage with some sort of a moat, then you can pour as much gasoline as you want, and it would not, in the form of cash, it would not really materialize into scale. It could, as a spike, materialize into scale as users, but not long term. So that's a very good lesson and great discussion. I was reading on one of your newsletters about Duolingo, and you mentioned Tesla as well. and others that are using AI to unlock new levels of scalability and leveraging systems and data to reach this massive audience and with really low marginal cost. What are and currently as companies are creating AI, especially enterprises that are building AI into their current products, and also startups that are building AI products, right? What should they embrace to achieve true scalability with AI?
Yeah, so it's a great question. I would say you brought Duolingo, and Duolingo is, I think, a very good example for that. And you can think about two different levers almost. You can think about someone like, actually, let me go back to Klarna for a second. So Klarna actually introduced that AI. It was actually together with the OpenAI, introduced this AI chat. They claimed that 2/3 of their customer conversation went through that AI chat. The equivalent of 700 agents, 35 languages. They reduce call resolution or conversation resolution from 11 minutes to 2 minutes, improved by 25%, significant improvement, $40 million in savings. Great. But this is not why people use Klarna. This is not their competitive advantage. It's going to be a pure cost reduction, and everybody in their industry will have to do that, right? So we will see AI as very pervasive, doing exactly that, and improving by doing that the scalability of the firm, because you take away jobs that in the past were just costs purely in terms of human and labor, and now you're making that into basically chips and the like. At this point, it's actually not that cheap, not much cheaper, to be honest, because cost of inference is very high and the cost of training is very high, but that will go down over time. I have no doubt about that. But then, I mean, the Duolingo example is a good example, because Duolingo and the type of firms that are using AI to really, I think, deepen their competitive advantage, and in multiple ways. Duolingo, I think, is one of these firms that try to strike a very, I think, hard balance between, on one side, teaching you a language, which is hard, and at the same time keep you entertained, and keep you on the system. And so I think what I think the main role of AI within Duolingo, in my opinion, is striking that balance in a way that, sure, they're adding now new features where you can actually have a conversation with like a person and stuff like it. But it's not there yet. But there is definitely that will improve. But it's very clear that the way they keep most of their customers alive is through that switching cost that is a little bit gamified, a little bit by learning. And I think firms that manage to integrate the AI better into their product, it's exactly as you said. It's not just like as an add-on like Klarna, which is basically now become a standard for everybody, but rather how do you integrate it in a way that does not allow someone else to do what you're doing, primarily because you use that AI to generate new data that then feeds into what you're doing. That, and the firms that are doing that are very few, right? This is Facebook at this point. I mean, Meta. This is a Duolingo as an example. To me, at least one great example, by the way, for that, where you see the beginning, but it's not there yet, is I have the Meta Ray-Bans. And I had an early Snap spectacles. I had a Google Glass.
Oh, you had those too. Okay.
I'm among the two people that had both, probably. One was on the spectrum of fashion. The other one was as unfashionable as possible.
I do like the Ray-Bans. They're really good. They're really cool.
Yeah. And the Ray-Bans are amazing. I came back from 2 weeks in France. And they're not there yet, but the fact that you can actually sit and listen to a conversation and translate that in real time. And then you go to a museum and you click and it actually reads what says there. And then you can just go around and they will tell you about where you are. And it's like, I'm not a heavy Facebook user at all. But if you now look at my time on Meta, I mean, the time probably multiplied by order of magnitude. Because now it's a new, and so I think firms that manage to do exactly that, which is, and that's why I'm not surprised that OpenAI took Johnny Ives, right, and as a designer, right? I mean, it's very clear that, I mean, Ben Thompson from Stratechery like to call OpenAI the accidental consumer firm, and I think that's some of that, right? If you have to rely on someone else's data, that's going to be very, very hard to develop your own proprietary AI. But if you actually can generate the data, then can train the model for whatever reason you're doing that. I mean, again, the OpenAI is not there yet, but you can see where these things are going. I think that's kind of thing where the promise is.
Something with it that you really highlighted for a lot of enterprise customers that I work with when they're like, we need to integrate AI in our workflows. And sometimes all we hear is that. And we don't hear the goals behind it. And we have to tease those out. I think this is exactly where you can utilize AI. To summarize what you just explained with these examples with Meta and Duolingo is, if you can use AI to create a bigger moat, right, and a stronger competitive advantage, utilizing all of these other moats you might have would be a package that you create that will then sell better. Or it's not just working on cost effectiveness of the organization that you have, but it's more so people are going to be willing to pay for the features and enhancements that you do. Because a lot of what we also see is enterprises, companies, they want to increase the usage of AI in their organization, but if it is only stuck to optimization, like the Klarna example that you mentioned, then it's hard to justify the ROI, especially right now, given we're still in times when AI is expensive, right? So very important as if people are thinking about introducing AI into the workflows. Okay, so the next thing that I had in mind, which is kind of related, you've talked a lot in class about bigger is not always better, and this is related to scale. So for companies, when is the right time to think about scale? And I know this goes into the scale framework a little bit as well. So especially if you're a startup, how do you think about when to scale?
Yeah, so to me at least, there are two key questions that are, I think about, like, in the early stage of a firm, you want actually, it may sound counterintuitive, but in most firms, that again, there's a spectrum here, so maybe you'll put OpenAI and Meta on the other side of the spectrum. But for most firms, you need to conserve cash initially, because the biggest risk is that you're building something that no one wants. And so I think the first step is you want to validate that you actually have product market fit. You want to validate what we like to think about is the value hypothesis, that you're actually solving a problem. And in my mind, I usually had this conversation with someone today. They had an amazing idea, but I said, that's great, but like, tell me what burning issue you're solving. And so what is how are you making sure you're selling a painkiller, not a vitamin? So that's step one. Step two is making sure that you know how to make money. And I'm not saying you need to make money now, but there is a viable path to profitability. And the path can be long. It just means that you need to align the right investors. But there is ultimately some line of sight into creating value. And I know it's 2025, so it might be controversial to say, but the role of firms is to create value to shareholders. I mean, someone is giving you money, they expect the money back. They might not want the money now. Many of them don't want the money now, because if they wanted the money now, they would do something else. But they want to see that there is some... And then we see these recessions when people realize, oh, that promise actually was not there. When I say until you validate these two, you want to grow, but you want to optimize for learning rather than for growth. And one of the best examples of that, by the way, is Stripe. Stripe, if you look at the early days of Stripe, they had many ways to grow, but they actually optimize for how do we make sure that with each and every transaction, each and every interaction, we actually learn. Even Facebook, that we tend to think that grew fast, Facebook was very controlled in how they grew. Not only to create this buzz around universities, but also because they knew the technology was not mature enough to be able to do what they wanted to do. They learned from Friendster that actually the current ecosystem was just not ready for that. But once you check these two boxes, so to speak, now is the time to aggressively invest in growth. And how aggressive, that's going to depend on the size of the market, your ability to build a moat, switching costs, exactly the thing we said will determine. And so a firm that has network effects and very high switching costs, okay, now here is a situation where, and there is a very well-capitalized competitor, you may need to go all the way and invest heavily in growth. If you're an industry where very weak network effects and it's not a big industry, so you can actually be a big fish in a small pond. Actually, you want to grow, but you want to make sure that you optimize also on your margins because, I mean, I think your ability to raise these massive rounds and to just, pay it out, I mean, it will just not be there. So I think, but I would say checking both boxes first, primarily if you're not in this extreme situation, is really my main condition.
That is great. And then when you grow big, and you think about companies like SAP and like that big companies, right? You've got a risk of what is called, and you define this in the class as well, organizational inertia, right? And how all the big firms, I've been at a few, what do you be careful of, especially right now, to stay competitive with your products. But I think there's also the team element, the organizational structure element that comes into play. It's just slower in innovation. Curious how you would advise companies like that have organizational inertia to break that and move faster or scale.
So first of all, we need to understand what causes that inertia. And what causes that inertia is that these are usually very successful firms. They manage to grow, they manage to build very impressive set of a customer base and tools. And then usually in that process, what happens is some type of attrition of the first people that actually drove the firm to be there. And so to replace these people and to actually start executing and meeting, and now when you're a public firm, there is also very high, many of them are public at this point, there is very high premium on hitting the goals, right? Wall Street penalizes you for missing your guidelines. And so you become a very mechanistic firm. And when I say mechanistic, you start having processes. And I'm a professor of operations, but I warn continuously about the role processes have on firms. I mean, I think the moment we add a process, we clearly create increased leverage. And so it's a great tool for managers. But at the same time, we are now inviting less of flexibility. We invite less innovation. We now invite people that like to perform and meet goals rather than thinking about beyond these goals and maybe sometimes not meeting these goals. So what happened over time is that we add these processes add people that like processes, and we start having goals that we want to meet, right? There is a performance review. In the performance review, we try to meet these goals. The performance review were defined. It means that I'm now not going to do the risking thing because I need to define something and then meet that. And that is great when you have a massive competitive advantage, because now you are Wall Street darling, you meet the goals, you meet the expectations, you do it well, you are, and usually if you have a massive competitive advantage, that's going to bode well. But then the main issue is that this inertia doesn't serve you well when there's now a significant change. And I wrote a couple of weeks ago about Google. Google, it's very hard to find a firm that had as massive advantage as Google had based on search and ads, right? I mean, this is just search. Google is the monopolist, even if you don't want to call it a monopolist. I mean, I'm not going to get into legalese here. And the results show it. So it's top 2 or 3 in terms of the size of the moat among given the small world of S&P 500 firms. Yeah. But what happened is that over time, people start optimizing for whatever was there. And when you do that, you get to a point where as long as everything remains the same, that's great. But now there is a new technology that started from within Google in many ways. Yeah. And you lost that muscle. You lost that muscle to now be agile, be fast, to be willing to sacrifice revenue, because sacrificing revenue means then alienating the market, the Wall Street. And that's what inertia is. And if you look at all the big firms that we know that failed, and I'm not saying Google is there, Google is far from there, but you mentioned Boeing, you mentioned Intel, Kodak, all of these firms are exactly like that. These firms that in one point, they defined the category, but became very mechanistic, and when technology shifted, there was just, the muscle was not there. What do firms do? So again, when that will be published, it will be probably a few weeks after that, but Google the last few days announced fairly big layoffs. When Elon Musk came to X, fired 70% of the people. I'm not saying you always have to fire people, but you can see from what I see within Google, DeepMind is becoming a bigger and bigger part of Google. There is a permission from within the firm to cannibalize some of the revenues that were actually coming from search. It's a mindset shift that requires that start from the top, but actually cascade very, very quickly to the bottom, because ultimately it's great if the people at the top say we need to be more agile, but the people at the bottom still have the same performance review. So the point here is that it has to come from removing people, roles, and processes. I don't think there is a way to do that without removing process and say that process we had for that, we'll just suspend it now until further notice, because this process is actually hampering our ability to do what we want to do.
Yeah. So all of the angles come together, the human angle, the people process, and the leadership angle. And also thinking about maybe switching the little bit of the moat or competitive advantage that comes in the process. Great. I think a few weeks ago, you also wrote about Apple and AI. And I really admired that article where you discussed why companies, just the factor of Conway's law, and you mentioned this too, companies like Apple and others who are trying to do and get into an area like AI. And Apple is a great example because you can see what they're trying to do, right? And it's just not hitting the right mark. Right. And so I'm curious, like how you would describe why enterprises like that are not able to get there, and what can they fix?
Yeah, it's a great question. And I'll say that when I speak with CEOs always like to tell me it's all about people. And I say, it's true that it's a lot about people. But if you don't have the right structure for these people to excel, you're going to bring amazing people. You're going to frustrate them and they're going to leave. And then you're going to say, we just didn't have the right people. No, you didn't have the right structure for these people. And so you mentioned Conway's law. Conway's law is one of my favorite laws that basically says that your product is going to mirror your organizational structure. And what it means is that whatever you prioritize and how you structure decision-making within the firm, your product is going to look like. So Apple is if I talk about moats, it's the top of the list. It's the firm with the strongest moat in at this point among all firms. And they built it on the heels of integrated product. You put the headphones, the power bits in your ears or the AirPods, and they start playing and everything integrated. And that integration is really built on the fact that Apple has essentially, and I'm simplifying things a little bit, a single decision maker at the top. And that was used to be Steve Jobs. And he says that I want to see how everything comes together. We might not be as fast as any other firm, but when we have a product, everything is going to be orchestrated together. Software, hardware, operating system, from the simplest product to the most complex one. And that's great. The issue is that doesn't really work well, A, for software, and B, specifically for AI. Because now AI requires a lot of experimentation. A lot of experimentation, in a sense, just the discussion, the beginning of the discussion illustrates, we don't really know what's the shape of the risk of the new solution. So either you have a strategy from the top, or you just allow for massive experimentation. Massive experimentation, that's exactly the point of Google. That's the point of Amazon. That's the point of Spotify. You have small teams working hard to try to find things, and you know that many of the products they're going to launch will be half-baked, but you're okay, because by the time you iterate on iteration 100, there is something that is better than what before. Apple just doesn't think like that. Apple wants the product to be perfect, and they wanted the AI to work on the iPhone, and they want to work on the iPhone well, and that requires a strategy from the top, and at the top they don't have AI people, and the structure is just not supporting that. So you see a situation where the firm is really struggling with that, but people had already, even before AI, that witnessed Apple's overall struggle with software, notice that it's really part of the structure, and the structure is it's interesting. The structure is of course driven by the fact that was initially a hardware firm, but it's really driven by Steve Jobs. And it shows you how much staying power the founder
Yeah.
footprint has. It still is
Yeah.
Steve Jobs' firm, even though he's no longer the CEO for many, many years.
That is such a great way of looking at it, and the way you see that it's all these teams are different. Like iPhone's made by another team, and AirPods are made by another team, and so if at least right now, if there's no overlap and cross-functional interactions, then AI needs to be infused in all of these elements, and you have to work together to get there. Such a great example. Now, switching a little bit to, and we've been talking about leadership and humans in the process and all that, but leaders that are leading the firm, especially right now with an AI-centric, need to have an AI-centric approach. What are the signs of a high-performing, adaptive leadership in order to scale companies?
Yeah. So I think the key question that many of them, so multiple things. So first of all, I think capability building, people that are willing to help their organization build capabilities, and to deal exactly with what we discussed now, which is faster experimentation, integrating with the product. But the second thing that I think is important is asking yourself, what will happen if we, like, basically try to envision a world and helping their managers envision a world that is very different from where they are now, that unless they envision that, someone else will go to envision it for them. And so I think the main issue and I was working with a firm recently, and I cannot mention the name, but it's very clear that for them to be able to now use AI in an integrated way will mean potentially to alienate a significant portion of their current revenues. And that will require someone from the top to say, we need to experiment with that, because if we will not experiment, we will see a fast firm coming and being willing to do that because they don't have anything at stake. And in fact, there are many startups now that already are looking exactly at their domain. I'll say it's in maybe I can say a word about it. It's in accounting. And many of the big accounting firms, a big part of what they do is time, material kind of contracts. But you see now firms that are coming and building as tech-first firms that are basically saying, we can do the same job that the other firms have done, but we can actually do it in a fraction of the cost because we build completely on AI, and we don't have revenues that are at stake if we don't win that contract. And so the goal of leadership is a little bit like what Google is going through now, is to say, we know we have this massive revenue, and we're willing to give some of that away, because if we don't do that, someone else will. But someone needs to come and say that, someone needs to create a culture to do that. And so I think leadership are now in a position of not only changing the metrics, changing the processes, reducing a bureaucracy, but also changing the culture of what again is allowed, what again is allowed to be questioned. How do you promote? How do you penalize? And so I think it's really going to be crucial years in the next few years for what, and we'll see what type of new leaders are going to emerge.
Yeah. Even the new roles are coming up with the different with difference in like AI flavors into them. And so and all of the jobs are getting infused with AI, so the roles are shifting ever so slightly. It's a slow evolution, but that is also something that needs to be envisioned and seen, whether the performance review for those roles, like to your point, actually meets the criteria or not. Are we evaluating people on the right metrics anymore because their jobs have moved or shifted slightly? And then, how do you create environments where this comes up quite significantly as I talk to enterprises, because people are used to doing what they do, and it's hard to change that. How do organizations create environments where learning and adaptation is prioritized alongside growth? And this is a large part of like, what are you hearing from your employees? What are you hearing from your customers? What are you hearing from the market? Or taking all of those signals in. How do you create that environment?
Yeah. So I think, to me at least, when I think about environment, when we talk about environment, there are multiple layers to that environment. But I'll say it's really about, as we said, four things to some extent. It's about rewards, it's about people. So hiring the right people with the right, so having reward the right behavior, having the people with the right mindsets, having the right process and the right structure. But in many ways, it's about creating the right culture. And so I'll say that for most leaders, there are really basically two important decisions that they need to make, which is who they hire and who they fire. And you see many CEOs, a big part of what they do in the first few days is try to bring new people that from their previous organization, people they promote. And I think the key over the next few years is going to be to try to see, like, if you want to see what firms are actually moving or creating that environment, are the firms where the biggest hire and the biggest promotion are going to be people that what they promoted were indeed faster learning, bigger experimentation, rather than better execution. Because execution actually may, and then of course they're going to be a part of execution as well. But how do you make sure that you don't prioritize execution over learning, primarily when the premium on learning is so high? And so, like, I think keeping that balance tight and making sure that, and I think that's part of, at this point, not clear as was successful, but as we have this conversation, but Meta's and Mark Zuckerberg's investment in hiring people. Or we mentioned Johnny Ives hired by, even if it's a very symbolic hire and there is nothing going to be done with that, then it's a symbolic hire. But if it actually OpenAI is going to come up with better design product and it's or a design product, I mean, that's going to be a massive signal for the prioritization within the organization. We'll say basically we are first, even though we have deep technology, we're first of all a product firm. We're then a technology firm. We know many other firms where we know that they're technology firms, and the product is I won't say an afterthought, but we mentioned Google Glass. Google Glass was not a well-designed product. It was actually technologically a really, really strong product. It was just not well-designed, and so it was, I think after a while, I'm sure if there are any designers there, they learned that that's really not where we need to spend our time, because everything is determined by the engineers ultimately. So I think the hiring the right people, hiring the right managers, prioritizing, promoting the right people based on that behavior is the main way that you create environment.
Yep. Then when you talk about culture, what I've also seen is that, and I guess maybe the two angles to culture. We see culture, we intentionally sometimes want to change the culture to drive these outcomes that we want to get to. But can it also happen unintentionally that we've drifted the culture from where which was our moat, to something that is not a moat anymore, because people like to work for companies, right? Like Google is a great example of that. Can you unintentionally drift culture that can lead you to losing moat, which was potentially culture?
Yeah, absolutely. Let me give another example for a firm that is somewhat in the news, and that's Boeing. Boeing, an amazing engineering firm, building planes, deep technology around it. We talk about technology as if AI is the only technology. I mean, building a plane is impressive enough.
It's a tech, yeah.
But then there was a change, and the change was basically we're going to try to change leadership from much more of an engineering leadership to a more financial leadership, and then you start optimizing financial outcomes, so return on net assets, and to do that, you start making simple decisions. You outsource production. You start focusing on planes that are that are, and you outsource more of the capabilities of like R&D. And then something very simple happens, right? The engineers that actually are very proud of their work leave because they want to work on engineering problems. They don't want to just coordinate among suppliers. And also you start basically in the name of, making numbers, you start not listening to whistleblowers or people from within the firm that talk about quality. And what you see at Boeing is actually a cautionary tale of what happened in 20 years, where step by step, you make simple decisions, and each one of them is applauded by the market, but each one of them takes you away from your core culture. And people like to say culture, it's strategy for breakfast. And I wrote a paper that was not a title at the end, but one of the intended title was, but now strategy, it's culture for lunch and dinner. And the idea was that there is a very much a close relationship between the two. Culture feeds your strategy, but the wrong strategy will now change the culture because the people will stay, people that believe in the new strategy that you have, and that will start getting reinforced. And so to me at least, I think the part that's interesting is exactly your point, which is this drift happened over years many times. And you don't notice that because it happens underneath. Like the firm is usually performing well and it attracts investors, it attracts employees, and then and everything is great until the music stops. And when the music stops, and music stops because there may be quality issue, maybe there's technological change, maybe there is a recession, can be different things, but then you realize there is really nothing there. And that is the biggest risk for most firms. Uber now, we talk about again about the fact that Uber is doing quite well these days, but Uber could have done even better. The only reason Lyft exists at this point is that Uber had that massive issues with its culture around bullying and sexual harassment, and if not for that, Lyft was nearly dead when that happened. There was a massive drift then from Uber to Lyft, and they needed a new CEO to change everything. And then so even when the firm is successful many times, it could have been even more successful if not for that period of time.
Yeah, that's such a great example. Final words. What are your final words of advice for companies that are trying to scale right now in this era? We're living in a very different time to build ventures that are AI powered and to scale.
Yeah, I think I go back to the point about building a moat. I think firms should think, clearly startups don't have moats. So you're not born with a moat. But how do you make sure with every single customer, you do a better job to the next customer? With every single query, you do a better job to the next query, either by reducing costs, by learning better who they are, or by connecting them better. And I think to me at least as a mindset, it basically, when you get into that mindset, you start realizing that it serves you on better processes, serves you on hiring better people, serves you also on prioritizing when is the right time to grow. And I think that it's a mindset shift for most firms. That would be, I think, to me at least, the one key lesson. The second one would be really about this notion of the damaging impact of processes. And I know most startups now at this point are not adding these, but sometimes you get into the temptation of, folks, let's just standardize things so we can actually move faster. In the short term, it may look as if, but over time, it just created inertia and ossification of overall the organization, which then it's impossible to undo. And I think for more mature firms, that's kind of the cautionary tale. How do you not get to a point where it's irreversible?
Yeah. Wow. That's amazing. All right, Gad, thank you so much. This was a very well spent 1 hour. I always learn so much from you. And thank you for spending this time with me today.
No, it was great to be here. Thank you so much for the invitation.
Awesome. Thank you.